Alibaba in 2025 has shifted from being thought of primarily as an e-commerce giant into a company betting its future on artificial intelligence, cloud, and data infrastructure. Earlier this year, management announced plans to invest approximately 380 billion Chinese yuan, which is about 52 billion United States dollars, over the next 3 years into artificial intelligence infrastructure and cloud expansion. That announcement sparked a dramatic reaction from investors, with the stock at first falling more than 10% because of concerns about capital intensity and margin pressure, and then rebounding as markets started to price in the potential of a true artificial intelligence pivot. In the most recent fiscal year ending March 31st, 2025, Alibaba's total revenue grew roughly 6% year-over-year in local currency. All 7 of its operating business groups posted year-over-year growth, though the pace varied widely. Its core domestic commerce division, Taobao and Tmall, generated about 62 billion United States dollars in revenue, growing at a modest single-digit pace. Its international digital commerce businesses produced close to 18.2 billion United States dollars in revenue, growing at a high double-digit pace. Cloud and intelligence services delivered about 16.3 billion United States dollars in revenue, expanding in the low double digits. Logistics, local services, digital media, and other categories rounded out the balance. In the most recent reported quarter that closed the fiscal year, Alibaba posted revenue of approximately 32.5 billion United States dollars, up about 7% year-over-year. Net income attributable to ordinary shareholders was 1.7 billion United States dollars, and adjusted earnings per American depository share rose roughly 23% compared with the same period a year prior. The company also executed buybacks, repurchasing about 51 million ordinary shares, which equals about 6 million American depository shares, at a total cost of around 600 million United States dollars. Alibaba is still showing the strengths of its ecosystem. It owns one of the largest digital commerce networks in China. It has logistics capabilities through Keniao. It integrates Alipay as a payments option, and it has a growing international commerce footprint. Its move toward artificial intelligence and cloud is reinforced by partnerships with leading chip makers like NVIDIA. And if it succeeds in embedding its language models across commerce and services, it could unlock new monetization streams with higher margins. It has also maintained a large cash position and is actively repurchasing shares, which supports investor confidence. But there are real risks. Chinese regulatory and policy uncertainty hangs over every large technology platform. The sheer scale of artificial intelligence capital spending, 52 billion United States dollars over 3 years, puts pressure on free cash flow in the short run. Competitive pressure is intense not only from domestic rivals like Tencent, Pinduoduo, Huawei, and ByteDance, but also from international cloud and commerce leaders. Consumer spending in China is under strain from macroeconomic headwinds, which affects core merchandise volume and advertising. And while the artificial intelligence push is exciting, execution and monetization remain unproven at scale. Technically, the stock has been volatile throughout 2025. After the artificial intelligence investment was announced, it dropped sharply and then recovered strongly. A sentiment shifted. The shares in the United States and in Hong Kong both hit multi-month highs following upbeat guidance and artificial intelligence product launches. Analysts have turned more bullish, with well over 90% now rating the stock a buy or equivalent. Price targets for the next 12 months have risen, with consensus around $180 per share, though bullish cases stretch above $240 and bearish cases remain closer to the $100 mark. In a bull scenario, Alibaba successfully monetizes its artificial intelligence and cloud investments, margins expand, and commerce stabilizes. In that case, the stock could deliver 40 to 70% upside over the next few years. In a base case, growth continues at a more moderate pace, margins improve slowly, and the stock delivers solid but not spectacular returns in line with other global growth technology peers. In a bear case, regulatory tightening, overinvestment in artificial intelligence, or macro weakness cause margins to compress and revenue growth to falter, leading to meaningful downside. Overall, Alibaba in 2025 is not a safe dividend or income stock. It is a growth transformation story. For investors with a long-term horizon and the ability to tolerate volatility, Alibaba is worth considering as a buy. The upside lies in its ability to turn massive artificial intelligence and cloud investments into cash-generative businesses. The risks lie in execution, regulation, and competition. The most disciplined approach is to take a moderate-sized position, monitor quarterly progress on cloud and artificial intelligence monetization, and scale into the position if the company proves it can deliver sustainable margin expansion while growing internationally. If you found this analysis useful, please like the video and subscribe for more weekly deep dives into global growth stocks and artificial intelligence opportunities. Hit the bell icon so you do not miss the next breakdown.